Let us see the next question. Mrs. Dhrumi Finance Limited has following investment held on March 31st, 2020. It wants to know the correctness of the investment that they have made. There are two securities in which the investment is made. The number of securities held by the investor, that is Dhrumi Finance, is provided to us. Respective beta is given to us. Market price of the share is given to us. And expected rate of return is given to us. Risk-free rate of return is 12%. Return on the market portfolio is 23%. First part of the question, on the basis of the data given above, calculate the risk of Mrs. Dhrumi Finance Limited's short-term investment portfolio in relation to market. That is the first question. Then the second part of the question is given that we are going to read later on. So the first part of the question says that you are required to make the computation of the beta of the portfolio. In a way that the question says that you are required to calculate the risk of Mrs. Dhrumi Finance Limited's short-term investment portfolio in relation to market. In relation to market stands for like the calculation of the beta of the portfolio. So I request all of you to make the calculation of the beta of the portfolio, and for that now you already know that the beta of the portfolio is calculated as simple weighted average. Calculate beta of the portfolio and put your answer in the chat box. So let us answer the question. Calculation of beta of portfolio. Dear students, we know that the beta of the portfolio is calculated as simple weighted average. So column number 1 is name of the security in which you have made investment. There are only two securities in which you have made investment. It is security A and security B. The amount of the investment is, we understand that you are holding 10,000 shares of A Limited, having market price of the share is 11. So it is 1,10,000. Next is B. In that, the 20,000 equity shares of the company, and market price is 17. So 20,000 into 17 is 3,40,000. So 1,10,000 plus 3,40,000. So that comes to 4,50,000. That is the total amount of the investment. Then we'll compute the weight or proportion in which the investment is made. Of course, friends, all of you must have understood that the proportion is required to be calculated in relation to the amount of the investment and not with respect to the number of shares. So the amount, that is the weight, will be 1,10,000 divided by 4,50,000. So it comes to 0.244444 like that. And over here 3,40,000 divided by 4,50,000. Of course, we will keep the weight in such a way so that the total is exactly 1. So 0.2444, that is subtracted from 1. So 0.7556. Multiplying with the respective beta. As far as the security A is concerned, its beta is 0.86. And for B, the beta is 0.75. So the last column will be weight into beta. So that will be 0.2444 into 0.86. 0.7556 into 0.75. 0.2444 into 0.86. So 0.2102. And 0.7556 into 0.75. So 0.5667 plus 0.2102. So 0.7769. That is the way, so the beta of the portfolio is calculated as 0.7769. So with paragraph write down, in order to compute beta of portfolio, comma, we have to take weight in proportion to investment. Full stop. Second part of the question, based on expected return, whether Messrs. Dhrumi Finance Limited change position of its portfolio. So the question speaks that taking into account this, should the investor say change the position of the portfolio? That is a question. Now friends, over here we can see that the information is provided to us regarding risk-free rate of return 12%, regarding return on the market portfolio 23%, and the beta is given to us 0.86 and 0.75. So what happens that the RF is there? Yes. RM is there? Yes. Beta is there? Yes. So you can compute the required rate of return. You have been provided with the anticipated rate of return in the question. So you can make the computation of the alpha. If at all the alpha is positive, we will advise the investor to hold the security. If it is negative, we will advise him that you should sell the security. That is the way we will be giving advice to the investor regarding the change to be incorporated in the portfolio. Answer for the second part of the question write down. In order to decide whether the company should change portfolio, we can compute alpha of security. Full stop. So write down answer. Alpha is equal to x bar minus required rate of return. So here is security in that A and B. Required rate of return, it is RF plus beta into RM minus RF. What is risk-free rate of return? Risk-free rate of return is 12%. What is beta? Beta is 0.86. RM is 23 minus 12. Next is again 12 plus 0.75 into 23 minus 12. That is the way we can compute the required rate of return. 23 minus 12 is 11 into 0.86. That is 9.46 plus 12. That comes to 21.46. Again 23 minus 12 is 11. 11 into 0.75 is 8.25 plus 12, that is 20.25. Lastly, we will make the computation of the alpha. Alpha is calculated as x bar minus required rate of return. What is x bar? X bar is 24 and it is 20, minus, so the required rate of return is 21.46, and over here it is 20.25. So in the first case, what will happen? 24 minus 21.46 is 2.54, and it is positive. In the next case, it is 0.25 negative. So what will happen? The security which has positive alpha, for that say you should continue to hold, and if at all you want to invest further, you can make investment further in that security, because technically it is an underpriced stock. As far as the security B is concerned, it has negative alpha, so you should sell that investment. We can say that it is overpriced, so you should sell the investment. So let with paragraph. Based on above working, comma, we can draw following conclusion. We understand that say there are two securities, security A and security B. Alpha for security A is positive and alpha for security B is negative. So you should hold question mark yes, and over here it is no. Should you buy further? Yes, you should buy further, and you should not buy. Should you sell? Question mark. No, you should not sell, and over here yes, you should sell the investment. We understand that say over here, like technically it is say considered as security A is underpriced, so you should buy it. And as far as the security B is concerned, it is overpriced, so you should sell it. And one more is so the plotting on security market line. I just give a small explanation to you that how these securities will be plotted on security market line. Now understand carefully, only for understanding purpose. Of course, over here from examination point of view, you do not have to draw all these things. But in this question, I just want to explain you. On x-axis, we take beta, that is so the independent factor. On y-axis, I am taking the return, that is the dependent factor. When the beta is 0, then the return from the security is equal to RF. As far as the security B is concerned, it has beta of 0.75. So taking into account the security B, beta 0.75, the required rate of return is 20.25%. So this is 20.25%. And you have been provided with the information that it has a return of 20%. So we can say that so the 20% is falling somewhere over here. So as far as the security B is concerned, which is overpriced and you should sell, is say plotted on SML, that is say plotted below SML, security market line. As far as the security A is concerned, it has a beta of 0.86. Taking into account the beta 0.86, we can see that so the required rate of return is 21.46. So this is 21.46. Okay. And so the mean return is 24%. So as far as the mean return is concerned, it is 24%. So mean return is 24%, so it is plotted above security market line. So somewhere over here. It is 24 percentage. This is the way we are required to say show the line, and of course we understand that say as far as the security A is concerned, it is lying above SML, above security market line. This is what's the kind of conclusion that we can say for like the securities having alpha positive and alpha negative. Right? This is the conclusion and this is the diagram. Diagram is not from examination point of view, but this is for understanding point of view. So finally, a small summary. First of all, we have computed the beta of the portfolio. Just be careful that the beta of the portfolio is supposed to be calculated as simple weighted average, wherein the weight will be taken in the proportion of the investment that you have made. That is, the amount will be taken into account. Second is that say we are required to make the, that is we are required to take a decision say regarding like reshuffling of the portfolio. For that, say we'll make the computation of the required rate of return, and based on that, so the alpha is calculated, and say based on the alpha positive or negative, we can have say certain conclusion. So that conclusion is also what we have understood. Alpha is positive, then you should buy, you should hold, it is underpriced, it is lying above security market line. This is what we understand, and this line is given a name as say the SML, security market line. This dotted line is basically indicating so the mean return, that is X bar, and so without dotted line is indicating the required rate of return. So basically what happens at say a kind of conclusion that say we understand is that as far as the security A is concerned, it is underpriced. So what will happen? Say everybody will do the transaction for buy. You purchase, 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 purchase. So what will happen? The price of the security will increase. Price of the security will increase in such a way so that the return of the security will fall down and it will lie on the security market line. As far as the security B is concerned, it is lying below SML. So we understand that everybody will sell, sell, sell. So the price of the security will fall down and it will reduce in such a way so that say again the security will fall on security market line. So basically as per CAPM, in an equilibrium situation, all securities will plot on security market line. Then on last conclusion, this all things are only for understanding purpose. Security lying above SML is underpriced, comma, so all investors will buy security and its return will fall equal to equilibrium return and security will lie on SML. Full stop.